If you're holding silver right now, or if you've been sitting on the sidelines waiting for the right entry point, what I'm about to tell you is going to change everything you thought you knew about this market. And I need you to understand something. This isn't hype. This isn't clickbait. This is a serious warning based on data that's hiding in plain sight, data that the mainstream financial media is either ignoring or doesn't understand. Because right now, at this exact moment, we are watching the silver market set up for something that hasn't happened in over 40 years. And most investors, even experienced ones, have absolutely no idea it's coming. Let me show you what I mean. On February 3rd, 2025, silver closed at $32.47 per ounce. Now, you might look at that and think, okay, silver's had a decent run. But here's what you're not seeing. In the last 12 months, silver has gained approximately 23%. Gold, during that same period, gained about 27%. So silver is underperforming gold, right? Wrong. That's exactly what they want you to think. Because when you dig into the actual data, what's happening beneath the surface is absolutely extraordinary. And it's setting up a scenario where silver doesn't just catch up to gold, it dramatically outperforms it. Just like it did in 1979 and 1980, just like it did in 2010 and 2011. Let me give you the facts. According to the Silver Institute's World Silver Survey 2024, which was published just months ago, global silver demand in 2023 reached 1.242 billion ounces. That's billion with a B. Now, how much silver did we mine? 830.5 million ounces. Do the math. That's a deficit of 401.5 million ounces. But wait, it gets worse, or better depending on whether you own silver or not. This isn't a one-year blip. We've had supply deficits every single year since 2021. In 2021, the deficit was 51.8 million ounces. In 2022, it jumped to 237.7 million ounces. And in 2023, it exploded to 401.5 million ounces. The deficit is getting worse, not better. Now, where is this silver coming from if we're not mining enough? Above ground stocks, inventories, warehouses, vaults. We're drawing down existing supplies, and those supplies are not infinite. Let me show you something that should terrify anyone who's short silver or waiting to buy. The COMEX, the Chicago Mercantile Exchange, is where most silver futures trading happens. It's the price discovery mechanism for the global silver market. Now, the COMEX has two categories of silver, eligible and registered. Eligible means it's sitting in a COMEX warehouse but not necessarily available for delivery. Registered means it's available to be delivered against futures contracts. In January 2020, before the pandemic, the COMEX had approximately 143 million ounces of registered silver. As of January 2025, that number has collapsed to just 39.8 million ounces. That's a 72% decline in 5 years. Think about that for a second. The registered inventory that can actually be delivered has dropped by nearly 3/4 while demand has been surging. What happens when too many people show up with delivery requests and there isn't enough metal to go around? We already have historical precedent for this. In March 2020, the gold futures market nearly broke because physical gold couldn't get to the delivery points in New York due to pandemic shutdowns. The spread between futures prices and physical gold prices blew out to over $60 per ounce. The market was screaming for physical metal, and the paper market couldn't deliver. Silver is facing a similar setup, but potentially much more severe. And here's the kicker. Open interest on COMEX silver futures is currently around 160,000 contracts. Each contract represents 5,000 ounces. That's 800 million ounces of silver being traded on paper. But there's only 39.8 million ounces of registered physical silver available. The leverage ratio is over 20 to 1. What does that mean in plain English? It means the paper market is massively overextended relative to physical availability. And when that disconnect becomes too extreme, the market corrects violently. Now let's talk about where the demand is actually coming from, because this is critical to understanding why this deficit isn't going away. Industrial demand for silver hit 645.7 million ounces in 2023. That's the highest level on record. And it's being driven by three unstoppable megatrends. Number one, solar photovoltaics. Silver is essential for solar panels because of its unmatched electrical conductivity. Every solar panel needs approximately 0.65 ounces of silver, or about 18 to 20 grams. In 2023, global solar installations reached 413 gigawatts. To put that in perspective, that's more solar capacity added in a single year than existed on the entire planet in 2017. And silver demand from photovoltaics hit 205 million ounces, accounting for 16% of total silver demand. But here's where it gets insane. The International Energy Agency projects that by 2030, we'll need to be installing 100 gigawatts of solar per year to meet climate targets. That's nearly triple current installation rates. If that happens, and governments worldwide are mandating it through legislation, silver demand from solar alone could exceed 500 million ounces annually. Where is that silver going to come from? We're already in a 411 million ounce deficit with current demand levels. Number two, electric vehicles and the broader electrification of transportation. A traditional internal combustion engine vehicle uses about 15 to 28 grams of silver. A battery electric vehicle uses 25 to 50 grams. Some high-end EVs with lots of electronics use even more. In 2023, 13.9 million electric vehicles were sold globally. By 2030, that number is projected to hit 40 million annually. China alone is targeting 40% of new vehicle sales to be EVs by 2030. The European Union is banning new internal combustion engine sales by 2035. California has the same ban in place. This isn't speculation, this legislated policy. And every single one of those EVs needs silver for its electrical systems, battery management, charging infrastructure, and power electronics. Number three, 5G infrastructure and the broader digitalization of everything. A 5G base station uses significantly more silver than 4G because of the increased number of antennas, the higher frequencies, and the more complex circuitry required. China has installed over 3.4 million 5G base stations as of the end of 2023. The United States has tens of billions of dollars committed to 5G build-out. Europe, India, Southeast Asia, they're all racing to deploy 5G networks. Each base station requires silver for antennas, circuit boards, and connections. And beyond 5G, we're seeing explosion in data centers for AI and cloud computing, Internet of Things devices, smart homes, autonomous vehicles, industrial automation. All of this requires silver. Here's the thing about industrial demand. It's inelastic. Companies aren't using silver because they want to. They're using it because they have to. There are no good substitutes for most applications. Engineers have tried using copper, aluminum, other materials. The performance isn't there. Silver has the highest electrical conductivity, highest thermal conductivity, and is the most reflective of all metals. You can't engineer around those properties. So when I tell you industrial demand is going to keep growing, I'm not guessing. I'm reading the installation numbers, the sales data, the government mandates. This is locked in demand for years to come. And beyond 5G, we're seeing explosion in data centers for AI and cloud computing, Internet of Things devices, smart homes, autonomous vehicles, industrial automation. All of this requires silver. Here's the thing about industrial demand. It's inelastic. Companies aren't using silver because they want to. They're using it because they have to. There are no good substitutes for most applications. Engineers have tried using copper, aluminum, other materials. The performance isn't there. Silver has the highest electrical conductivity, highest thermal conductivity, and is the most reflective of all metals. You can't engineer around those properties. So when I tell you industrial demand is going to keep growing, I'm not guessing. I'm reading the installation numbers, the sales data, the government mandates. This is locked in demand for years to come. Let me give you specific examples from major producers. Pan American Silver, one of the largest primary silver producers in the world, reported 2023 production of 20.3 million ounces. That was down slightly from 2022. Their guidance for 2024 was 21 to 23 million ounces, essentially flat. Fresnillo plc, another major producer, reported 2023 silver production of 52.7 million ounces, down 5% year over year. They're struggling with ore grade declines at their aging mines. First, Majestic Silver produced 12.8 million ounces in 2023, down from 13.4 million in 2022. These are the biggest players in primary silver mining, and none of them are meaningfully growing production. In fact, many are dealing with production declines. The bottom line is this: supply is constrained, costs are rising, and there's no cavalry coming to rescue the market with a flood of new production. Now, let's talk about investment demand, because this is the wild card that could send silver prices into the stratosphere. In 2023, physical silver investment, including coins, bars, and other forms, totaled 269.7 million ounces. And that's up 28% from 2022. People are waking up to the value proposition of silver. The US Mint is a great indicator of retail demand. In 2023, they sold 44.25 million American Silver Eagles. In 2024, they sold 35.78 million. Even with the slight decline in 2024, these are historically very high sales numbers. And here's what's interesting. Premiums on physical silver have remained elevated. Normally, you might pay $1 to $2 over the spot price for a Silver Eagle. Right now, depending on where you buy, you're paying $4 to $7 over spot. For a 1-ounce silver round from a private mint, you're still paying $2 to $3 over spot. What does that tell you? Physical demand is strong enough that dealers can charge these premiums and still move inventory. The physical market is tight. But here's where it gets really interesting. ETF holdings of silver have been relatively stable. The iShares Silver Trust, ticker SLV, the largest silver ETF, holds approximately 460 million ounces. The Aberdeen Standard, Physical silver shares ETF holds another 175 million ounces. Combined, the major silver ETFs hold around 700 million ounces. That's a lot of silver. But here's the key. Those holdings haven't grown significantly in the past year despite silver prices moving higher. What does that mean? It means the big institutional money hasn't piled in yet. Hedge funds, pension funds, sovereign wealth funds, they're not massively overweight silver right now. And that's actually bullish, because when institutional money does start flowing into silver, there's nowhere near enough supply to meet that demand without prices going significantly higher. Let me give you a thought experiment. The total value of all the silver in the world, including above ground stocks, is estimated at around $1.4 to $1.5 trillion. That sounds like a lot until you compare it to other asset classes. The global stock market is worth over $110 trillion. The bond market is over $130 trillion. Global real estate is estimated at $326 trillion. Even the gold market is worth about $13 to $14 trillion. Silver is tiny by comparison. What happens if just 1% of global financial assets decide they want silver exposure? That's 1% of, let's say, $200 trillion in stocks and bonds. That's $2 trillion trying to get into a $1.5 trillion market. Prices would go absolutely ballistic. The market simply cannot absorb that kind of demand at current prices. Now, let's talk about the macro environment, because what's happening in the global economy is setting up perfectly for precious metals. Since 2020, central banks worldwide have engaged in unprecedented monetary expansion. The Federal Reserve's balance sheet went from about $4 trillion before the pandemic to nearly $9 trillion at its peak. Even after quantitative tightening, it's still sitting at around $7.7 trillion. The European Central Bank, the Bank of Japan, the People's Bank of China, they all did the same thing. Trillions of dollars, euros, yen, and yuan were created out of thin air, and that money has to go somewhere. Now, the Federal Reserve raised interest rates from near zero to over 5.25% to fight inflation. But here's what most people miss. Real interest rates, which is the nominal rate minus inflation, are what actually matter for non-yielding assets like silver. If inflation is running at 3 to 4% and the Fed funds rate is 5.25%, real rates are only 1 to 2%. That's historically low. In the 1980s and 1990s, real rates were often 3 to 5% or higher. So even with rate hikes, the real cost of holding silver isn't that punishing. And here's the bigger issue. The U.S. national debt just surpassed $36 trillion. Annual interest payments on that debt are now over $1 trillion per year. That's more than we spend on defense. The Congressional Budget Office projects that by 2034, interest on the debt will be $1.6 trillion annually. This creates a fiscal trap. The government can't afford to keep rates high indefinitely because the interest burden becomes unsustainable. But if they cut rates too much, inflation could reignite. They're stuck between a rock and a hard place. When investors lose confidence in the government's ability to manage its debt or the currency, they move to hard assets. Gold and silver benefit enormously from that loss of confidence. We're already seeing signs of this. Central banks bought 1,037 metric tons of gold in 2023, the second highest level on record. China, Russia, India, Turkey, Poland, they're all accumulating gold. Why? Because they're diversifying away from dollar-denominated assets. And while central banks focus on gold, savvy investors are looking at silver because of its dual role as both a monetary metal and an industrial commodity. Geopolitical tensions are also running extremely high. The Russia-Ukraine war is ongoing with no clear resolution. U.S.-China relations remain strained over Taiwan, trade, and technology. The Middle East is a powder keg with conflicts in Gaza, Yemen, and tensions with Iran. Every one of these situations creates uncertainty, and markets hate uncertainty. When geopolitical risks rise, investors seek safe haven assets. Precious metals are the ultimate safe haven. Now let me show you the technical picture, because the charts are confirming what the fundamentals are telling us. Silver recently broke above its 200-day moving average with strong volume. That's a major technical signal. We've also seen a golden cross, where the 50-day moving average crosses above the 200-day moving average. This is typically interpreted as a long-term bullish indicator. Looking at the weekly chart, silver has been building a base between $22 and $30 for nearly 3 years. This kind of prolonged consolidation often precedes significant moves. The longer the base, the stronger the eventual breakout. From a Fibonacci perspective, if silver breaks decisively above $34, the next resistance levels are at $38, then $42 to $44. Above that, there's not much resistance until we get back toward the 2011 highs near $50. And here's something critical. The gold to silver ratio is currently around 87 to 1. Historically, that ratio averages closer to 60 to 1. When it mean reverts, and it always does eventually, that implies significant upside for silver. If gold stays at $2,600 and the ratio drops to 60 to 1, silver would be trading at $43. That's a 33% gain from current levels. If gold rallies to $3,000, which many analysts expect, and the ratio hits 60 to 1, silver would be at $50. That's over 50% upside. But here's where it gets really interesting. In previous precious metals bull markets, the gold to silver ratio has compressed much more aggressively. In 2011, it briefly hit 30 to 1. In 1980, it got as low as 17 to 1 during the silver mania. I'm not predicting we'll see those extremes again. But if we even get halfway there, say to 45 to 1, with gold at $3,000, silver would be trading at $66 per ounce. That's more than double current prices. Now, let me give you the warning, and this is critical. Silver is not a get-rich-quick scheme. It's a volatile, sometimes illiquid market that can swing wildly in both directions. We've seen silver drop 30% in a matter of weeks during corrections. If you can't handle that volatility, this is not the right investment for you. Second, timing is impossible. I can't tell you that silver will hit $40 in 6 months or $60 in 2 years. Nobody can. What I can tell you is that the fundamental setup is extraordinarily bullish. Supply deficits are real. Industrial demand is growing structurally. Investment demand is starting to wake up. The macro environment favors hard assets, and the market is small enough that when capital flows in, prices move violently. Third, physical silver is different from paper silver. If you buy physical coins or bars, you own the metal. It's yours. You can hold it. But you also have to store it securely, insure it, and pay premiums when you buy and sell. ETFs, like SLV, give you price exposure without the hassle, but you don't own the actual metal. Mining stocks give you leverage to silver prices, but come with company-specific risks like management quality, operational issues, and jurisdiction risks. My suggestion? Diversify your approach. Have some physical metal for true ownership. Have some ETF exposure for liquidity. Maybe have some mining stocks for leverage if you understand the risks. And dollar cost average. Don't put your entire nest egg into silver at one price point. Buy consistently over time. That way, you average out the volatility and don't get caught buying at the top. Here's my bottom line. The data I've shown you today is not speculation. It's reported by the Silver Institute, the COMEX, major mining companies, the IEA, government agencies. This is real, verifiable information. We have supply deficits that are getting worse, not better. We have industrial demand that's growing structurally due to solar, EVs, and electrification. We have a macro environment of monetary expansion, fiscal dysfunction, and geopolitical tension. We have a market that's tiny relative to other asset classes and can absorb significant capital inflows without prices surging. And we have a setup where the paper market is massively leveraged relative to physical availability, creating the potential for a squeeze that could send prices parabolic. I'm not telling you to bet the farm on silver. I'm telling you that if you have zero exposure to silver right now, you're potentially missing one of the most compelling risk-reward opportunities in the entire commodity space. The warning is this: don't wait until everyone else figures it out. By the time silver is on the cover of every financial magazine and everyone's talking about it at cocktail parties, the easy money has already been made. Do your own research. Look at the data I've presented. Make your own decision. But make it an informed decision based on facts, not fear or greed. The silver market is sending signals that something big is coming. The question is, are you paying attention? Thanks for watching. Stay safe, stay informed, and I'll see you in the next one.